screen back up real quick. And stop my recording.
It's a pleasure to be here, and happy Thanksgiving weekend to everybody, or happy Black Friday, I suppose. Let's get right into it. So the DNA of technical trading. Today we're basically going to break down a strategic way to build any strategy from a ground up. And through my experience, we went on to, it's our 9th year in business. Actually 2 weeks ago was our 9th year birthday. And one of the resounding things that I hear from my students about what they really find the value that we teach is the core concept of the why behind the what. Now, you can buy any indicator, any scan, any strategy, but unless you understand the why behind what you're doing, you'll never end up having confidence in it. And today we're going to talk about the why behind the what, which is the market and why things move. So quick disclaimer, Acorn Wealth is an educational company. We will be talking about live markets when we get towards the end. Of course, this is for educational purposes only, not a recommendation to buy or sell. All right, so today's agenda. So we're going to talk about, I'm a big believer in systems. I'm all about the S's, systems, strategy, and scanning. If you want to call it the 3 S's, systems, strategy, and scanning. And maybe the 4th would be simplicity. So anything we do should have structure. And the whole purpose of today is to talk about a top-down decision tree to decide not only which direction the market's likely to go next, but which strategy we then want to apply and what strategy rules we need to use. We're going to talk about why it's critical to differentiate between oscillating and momentum cycles and how to profit from them. Very importantly, how to identify when a trend actually starts and when it ends, and why most people, even experienced traders, get it wrong. And we'll be talking about some of my favorite indicators and how to use them in scans. So lots to go through. The reason why systems are important is because most people don't have them. And even if they have them, they don't use them. And the lack of confidence in a system means a lack of action, which is why most people fail. And this, of course, results in all the other problems what people end up struggling with, which is obviously knowing when to get in, knowing when to take profits, selling too early before a stock takes off, and this is a big problem for people because then they lack structure, they lack simplicity, because they're so concerned about whether they're right or wrong that they forget about the most important thing, which is to make decisions by the rules. Don't micromanage your trade, simply follow the rules regardless of what you feel. But of course the market is engineered to take us away from our rules, to take us away from our systems. They simply want us to invest emotionally. Oh, Trump's winning, sell everything. Oh, hang on a second, Kyle Icon's buying, buy everything. You know, we're constantly being forced to feel in panic mode all the time, which always generally results in losses. And so what we need to do is take away that noise and replace that with systems and replace that with rules that we can say, okay, regardless of whatever anyone else is telling us, this A plus B plus C equals yes, I'm going to buy that trade, regardless of what the market makes you feel. And that's exactly what we're going to focus on, those simple and direct systems that allow you to make decisions from the ground up with a rule-based foundation. So let's go into the topic. Again, the theme of today we'll keep coming back to is take calculated risks, which is quite different from being rash. So as we approach the market and we think, well, how do we approach with a system what the current market conditions are doing? Well, instead of asking whether it's a bear or bull market, the more important question is, well, what do the systems tell us? What does the DNA or the blueprint of the market suggest? Well, to do that, let's firstly go back to some basics, the ABCs of trading. Now, because you're all here, then you are already educated on this. I mean, TradeThirsty brings a wonderful group of educators and a wonderful group of students, therefore. So we all know that there's 3 types of markets, but let's go in depth a little bit more. Obviously, there's uptrending markets, which most people define as higher highs and higher lows. We're going to challenge that, though, today. Obviously, we've got downward markets, which are lower highs and lower lows. We'll challenge that as well. and we've got sideways markets, which of course which are fantastic if you sell options to make money in those markets too. My main point is that there are 3 different cycles of the market in terms of directions, and you can profit from all 3. So when I hear people saying, well, I only go long, well, then you're only taking advantage of 33% of the market direction. If you want to be able to develop a strategy to make money in any direction, regardless if you're trading from an IRA, a 401k, no matter what. But what is less understood is not just taking advantage from the 3 different market directions, but also taking advantage of the 3 types of market cycles. And even if this is understood, it's not always well practiced. How many people here are not really comfortable with the differences between oscillating, consolidating, and momentum strategies? How many people or how many people here are experts? How many people are new to this concept? Because this is a critical thing to understand in trading. The difference to how you approach a lot of new people, great, okay. And please throw your hat in the ring so I know how much time to spend on this. If we've got a lot of people that are new to it, we'll spend a bit more time, if less time. This is a very, very important concept. The difference on how you approach an oscillating trade versus a momentum trade is as different as a long to a short. So if you go in and start applying a momentum strategy to an oscillating stock, you're almost guaranteed to lose. So what are the differences? And this is, again, the core concepts of the DNA of technical trading, or the blueprint of the market. The first type of cycle that a market will go through is oscillating. Now, so essentially when you first look at a stock, the very most important thing, or the first most important thing you have to do when someone says, hey, buy IBM or short Amazon, and you bring up that chart, the first thing you have to do is understand how that stock breathes, what personality that stock is. And what that means is looking at it and saying, okay, what makes this stock go up and what makes it go down? Because those things are going to tell you where and when you want to enter and exit. So when you look at a stock, you want to say, okay, what is the personality or the system that controls how the stock moves? So a lot of people say, okay, well, basically, I'm going to buy the stock, when it crosses above the moving average. Okay, well, that's great if you're dealing with a momentum stock, but moving averages don't work on oscillating. So let's go back to this concept. If we're dealing with an oscillating stock, when you look at the chart, what you're going to see is that what makes the stock go up or down is not moving averages. It will be static or straight lines that essentially contain the stock's movement. So when you look at the chart, you're saying, okay, like a detective, why does this stock change direction? And if you look at something like this, you can see that every time the stock changes direction, it can be explained with 2 straight lines that control that system of movement. That then changes here. So that's oscillating. That then changes here to, again, 2 straight lines, but without direction. So it's still a type of oscillation, but without direction, it's consolidation. Then after that, you can see that we change systems again, and all of a sudden, you couldn't describe how the stock moves with straight lines. If you did, the lines really wouldn't work. What explains the way the stock moves in the third cycle is the moving average. So we go from oscillation to consolidation to momentum. Now we're going to go back to defining this further in a moment, but that's the basic concept. All right. So this is important to figure out, because once you have determined what type of personality the stock is, the rules that you use to approach it dramatically change. So the question I would ask people here as we go along is, what is your particular strategy? What do you focus on? When you search for a trade, or you set up your scans, or you're going through the S&P 500, what exactly do most people here look for? Do you know what you're looking for? Are you looking for an oscillating trade? Is it momentum? Is it a head and shoulders? Is it? Do you know exactly what you would define to look for? Because ultimately that is a very important, just gambling, says Andrew. Okay. It's really important to define exactly what you're searching for, because if you don't know what you're looking for, then any trade will work, or more likely not work. Or as the saying goes, if you don't know where you're going, any road will take you there. So, so what we need to do is we need to start defining what are the core things that make a profitable trade, and start to build this into a recipe that we can start scanning for. So to do that, let's start to ask some core questions. Firstly, who controls the market? I mean, obviously, if we're going to start reverse engineering the biggest movers in the market, then we should first understand, well, what makes something move? Well, obviously, the most simplest explanation is volume. Volume dictates price. So, who dictates volume? Well, as we all know, these days, market movements have absolutely nothing to do with fundamentals. In fact, if you look at what stocks are rallying over the last couple of weeks, they're all garbage stocks. Capital One, American Express, garbage. I mean, these are the worst of the credit card companies. I mean, you look at Visa and MasterCard, they're going nowhere. But Capital One and Amex are on a run. Cummins Diesel, they can't give away machinery, but their stock is rallying. I mean, so sometimes when you look at what's moving, it doesn't make any sense at all, and you scratch your head. I stopped bothering about being right on being an intellect about the market years ago. What I worry about is what is the smart money doing, because that's ultimately what will drive price. And 80%, if arguably more, of the market comes directly from these smart money algorithms. The way they make decisions isn't on fundamentals. It's based on patterns and preset levels of buying and selling. And what's more is they're making billions of dollars every day doing it. So if you think about the power of these algorithms, think about the flash crash in 2010, when the market plunged 1,000 points and then almost instantly recovered minutes later. And more recently, think about the Trump win. Now, whether you like him or hate him or agree or disagree, what happened in the stock market was fascinating. The market sold off 1,000 points and then hit a preset level and just instantly recovered all of those losses and then tacked on another huge move to the upside in the days following. Does that make any sense? Do you think it's just suddenly everyone changed their mind instantly? No, absolutely not. These are powerful forces that predetermine where they get in and where they get out. And if you think Kyle Icahn was the reason that the entire market rallied, I don't believe that either. I think that when they say he went and bought $1 billion worth of stock, well, keep in mind that buying $1 billion worth of stock is the same as covering $1 billion worth of shorts. You're still buying. And the only thing he was mostly buying was the S&P 500. So in my mind, he's simply cashing in on a massive gamble to the short side that after a 5% overnight drop, everyone was taking their profits, wouldn't you? And this is what we need to understand. And this is what we want to reverse engineer. So to take all the garbage out, it's actually fairly simple to reverse engineer this process, to figure out where the smart money is going to get in and get out. And this comes back to the original core concept we introduced when we're talking about the cycles of the market. What we need to understand when we first look at a stock is to understand its personality. What makes it move? Because what we're essentially doing is we're trying to figure out what's the game plan behind the stock's chart. Now, I heard Jeanette talking about the Gators, or we've probably got a great weekend of football ahead of us. Now, as you can probably tell, I'm not from America. If I did, I'd have a very distorted accent. So I grew up in Australia, and I moved here and started Acorn over 16 years ago. The first football game I ever watched, I sat down, I couldn't understand it whatsoever. I think it was a Raiders game, which I was watching in LA. And the kind of whistle blows, and all these people run across the field at each other, knocking each other down and smacking each other in the head. And one guy throws a ball somewhere, and I'm looking at this, I'm like, this is chaos. What the hell is going on? And then the more and more I watched it, the more I realized it wasn't chaos. It was actually a very well-structured pattern that the team was following. And when that play went down, although it looks like chaos, each player knew exactly where they were going to orchestrate a win. And when you look at a chart, that's exactly how I think about stocks. I think about the stock market as basically a series of about 100 different patterns that a stock can play, whether it's a double top, a double bottom, a head and shoulders. There's about 100 different patterns that exist in the market. And what the smart money does is it's kind of like a football coach saying, right, what play are we going for now? All right, let's do a Hail Mary. All right, now we're going to do a rush. And it's kind of like the smart money or the market makers going, right, now we're going to have an upward channel. Now everyone knows an upward channel, right? That's going to break down afterwards. Then we're going to go into a head and shoulders. That's going to break down after that. Then we're going to go into, you get my point. So when we look at a chart, we're trying to figure out what play is happening to tell us what the probability of the move is next. And that's what algorithms do. They don't see this. They see rules, levels to buy and sell at. So flash crashes, all those types of things. It's just about breaking down to those key levels. So let's look at the S&P 500, for example, and apply this theory. So let's bring up the SPX, if I could type properly. Here we go, SPX. All right. So, real simple. Everything is organized chaos. Just like the football example. Real quickly, look at the breakdown we had in 2004 to 2007. Upward channel. Bang, 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 bang. So basically, when we look at a chart, as I said, the first rule is to figure out what system is controlling the stock. Now, when you look at the rally of 2004 to 2007, what system was in power? It was an oscillating one. As you can see, the system that defines every single major turning point in that 3-year rally was one of two lines. The moving average didn't mean anything. The stock just cuts through it and cuts back through it, cuts through it, cuts back through it like butter. So the moving averages don't matter if you're dealing with an oscillating trade. The S&P was oscillating, and by defining that pattern, we're then able to see that it broke that pattern at this point. A new pattern then formed. And as you can see, this was a very clean head and shoulder that then popped out. That head and shoulder, then using the rules, we measure the head and shoulder. That's how much it broke down. We then form another downward head and shoulder. So by defining the pattern, we can see this therefore dictates that a break should happen from just under 1200 down to 1000. That's exactly what happens. And then we get the inverse head and shoulder at the bottom, which creates the rally. So the entire 2008 chaos was all, in fact, a very well planned and orchestrated set of 3 head and shoulders that told you exactly where the market was going to drop to and where it would recover to. Now, if we apply that to the current market conditions, you can see we've had another similar oscillating rally. That oscillation ended here in July 2015. By understanding the pattern and the system of that was controlling the S&P 500, we can then identify that as an upward channel. The playbook tells us to measure from the top of that channel to the bottom, and that's how far we should break down. We measure that. You can see that's exactly where the S&P 500 broke down to, right down to this level. There you go. We then bounce, and so we know that this system has therefore, so we're thinking about the playbook, we know this system has ended here. It's finished its play. So by knowing that the system has then ended there, we then know something very important. We know when to start looking for the new system. Exactly there. So that's where we start drawing our next support and resistance from. We watch the market rally, we watch it drop, and then we watch it break through. Now all of a sudden, again, think of the playbook. What do we know about downward channels? Well, what we should know about downward channels is that they normally bounce 3 times before breaking out. You'll see that in almost any oscillating pattern. It's called the rule of 3. And what we see here is only 1 bounce and then a breakout. So immediately we know this wasn't a downward channel, it was in fact something else. And we start to go to our rule book and say, well, what else fits that type of a description? And what we've been looking at is the potential for a longer term head and shoulders to be forming. Now, let's zoom into current day and go to our daily chart. Again, we're going to take off the moving averages because right now we're going to clean the chart up and just look purely at support and resistance systems. So right now we have been in a downward channel through all of August, September, October. So prior to the election, one of the things that we talked about in our trading room on, what was it, November 8th, we said, look, if we get a break out of this channel, then we're going at least to 2010. Regardless of who wins, we're going to 2210. And as you can see, because that is the measurement of that rule system applied to current day. Now where we're currently at, 2213, brings us to our next critical test point. My anticipation is we'll probably hang in here but between now and the end of next week, and maybe at most test the 2240 level, which is a fib extension of the previous rally. And this is where we'll get a test of whether we're going to be going further or whether we form this tip of the head and shoulder. So as you can see, this is basically how we get all of our market directions. It's not through listening to BNN or CNN or QNN or whatever 3-letter acronym you want to use. It's by simply looking at what is the support and resistance telling us is happening. So let's talk about how we interpret the support and resistance. Obviously, the first rule is to determine whether we are dealing with oscillation or momentum. Okay? The real easy way to do that is simply to look at the stock and say, right, what makes this thing tick, right? So if we're dealing with oscillation, I'll give you an example. This is one of our long alerts right now. We sent this one out as a long alert when we broke through here at 2750. This is CBRE Group, which is a industrial property management group. Now, why did I like this as a trade? Well, because the first thing I saw when I looked at this stock is I said, what makes this tick? What makes this go up and down? Is it moving averages? Well, let me have a look. Nope, not moving averages. Moving averages don't mean squat to this stock. They do not hold it down. They do not hold it up. Therefore, you can basically rule out any momentum strategy on this. That means RSI doesn't work. It means MACD doesn't work. It means you can throw your directional movement out the window. All of these popular indicators do not work, including moving averages, if you're dealing with an oscillating stock. So obviously we look at the stock and say, right, it's not momentum, so we can can that. So what does work? Well, firstly, static support and resistance. Bang. In 2 quick lines, we've now established everything that makes this stock go up and down. This then tells us the personality. It tells us we're dealing with a downward oscillating channel. So then we consult the rule book. What does that mean? That's a bullish pattern, and we are simply waiting for the breakout above that resistance, which happens here, and we go long. How far should it go up? All right, well, we measure the distance between the top of the channel and the bottom. Okay, there we have it. We duplicate that there, and that tells us our target. So our target on this was from $27.50. We looked at the, I think it was the $28 calls, and our target was $30. Right now, you can see we've rallied almost up to that level. And can anyone tell me what, for the gold star, what pattern do we now have forming at the end of this rally? Anyone know? And we know we're dealing with an oscillating, yep, Lou, you got it. It's a flag. At the very end of this pattern, because we know we're dealing with oscillation, we look for oscillating patterns. And there, right at the end, you get a little bull flag right there. Flags are incredibly powerful, and in any market condition you can trade them. Bull flags work in down markets, sideways markets, especially in up markets, because what they're defined as is a massive surge in volume as a stock makes a massive move through core resistance. It is the #1 most profitable and most probable trading strategy out of the 100 patterns that exist. It is the most reliable and most probable. So when we get a flag, which on the short term, confirming our medium term pattern, we then measure that flag, and there you go. Now it might not mean much, but this certainly gets us to our target of $30.13, possibly higher. We can then consult the weekly chart, and the weekly chart tells us that we actually have a pennant formation, which again we simply measure the top to the bottom, duplicate that, and that tells us we're going to 38 if we break through that 30 level with confidence. And as you can see, all of this fits together like a really nice jigsaw, because that brings us up to a double top, and it also brings us back to the resistance on a long term. So what do I think about CBRE? Who cares? My opinion doesn't matter. What matters is that the smart money rulebook, based on understanding the DNA of the market and what makes things move, tells us where this stock is most probable to go based on simply understanding how to identify these patterns using this support and resistance. Any questions so far? All makes sense? How's everyone doing? Awesome. Good on you, Peter. Excellent. Wonderful. Let's move on then. I love this stuff. You can probably tell. All right. So the first thing is when we start defining this, it breaks things down to simplicity, simple stuff that we can apply. So oscillating markets, just to wrap that up, they bounce between limits. Moving averages are therefore ineffective, and we're most concerned with the static levels. All right, let's move on. So how do we make that even more probable? Well, we can correlate that with the market. We can correlate that with sectors. And we can look at the strongest levels of buying based on how the stock reacts. So in essence, what this all comes back to is a core concept to understand with oscillation. The power of an oscillating chart is going to be dictated by how the stock bounces. So again, if you're trying to trade a double bottom or a double top, or whatever the case might be, what makes that trade powerful? What are you wanting to happen the second that stock hits that support? What are you wanting to happen? You're wanting the high frequency trading to come in and just boom, just throw their billions of dollars at it, right? You want it's like a light switch that goes from red to green the second that level hits. That's what makes it exciting. That's what makes it oscillate. It's like a 100-ton truck going down the highway that comes to an instant stop and turns around and goes the exact same speed in the opposite direction. Why is that exciting? Because that takes Superman powers to make that happen. Now, when you're 95% of the volume in the market, like high-frequency trading is, you can make that happen because you have that Superman power. When a price hits, you go from selling $30 million a day to buying $60 million, and that can turn the stock around on a dime. So what you're looking for in a powerful reversal that you want to trade is you're looking for where a stock has dropped maybe 10, 20%, hit a support level, and then a second later gone straight back up. That's that Mack truck being turned around. So the next, and not the fifth or fourth or sixth time next time, the very next time, that's when you get your most powerful buy, and that's what you're looking for. So in an oscillating stock, in essence, we want to buy that powerful support on the way down once we recognize that area. So oscillation, obviously, we're buying the drop. We're selling the rally. Now this is very different. So here's an example, obviously. Oscillating stock, we're buying the drop, selling the rally. Buying the drop, selling the rally. Buying the drop, selling the rally. Now this is very different from momentum. So if we start to see that, you know what, static lines are not what's controlling the stock. In fact, it's actually a moving average. That seems to actually explain the stock's move. Now these are really great trades because they can last a lot longer. In oscillating trades, you're in and out, you know, within maybe 3 to 5 days, and you're looking for a 8 to sometimes 20% move because it's dramatic, it's sharp. Something like Aaron's is a great example of a very powerful oscillating stock. You can go back over the history of time. This thing just is very, very powerful at oscillation. You just look at this level. Bang, breaks out, 20% rally. Back at support, rally. Back at support, rally. So things like this work really well with oscillation. Back at support, rally. Back at support, 33, bang, all the way back up to 37. Very, very cool. You can pre-program these trades weeks or months ahead. A moving average or momentum trade is very different, and here's a great example of one. These stocks don't go through those dramatic types of moves. They don't feel as much of a roller coaster ride. They're kind of long and steady, slow and steady wins the race. And what describes their power is momentum. So a lot of people talk about how they wait for a stock to confirm before they buy. That's not what you're actually doing. What you're actually doing in any kind of trade, or what you should be doing, is buying support, selling resistance. And that's why it's so important to understand what support and resistance matters to the stock you're analyzing. Otherwise, how do you know what support to buy? If you're oscillating, the support is underneath you. So as the stock drops, you're going to buy it. You're going to catch that falling knife. Because what you're buying is the most powerful support, which is the oscillating level. And then what you're selling is you're selling the resistance because this is the most powerful level. Not the moving average behind it. Because if you're oscillating, it's most likely to break down because this level is more powerful than the moving average. Again, because you're oscillating. In a momentum scenario, what's most powerful? Not the horizontal level. It's the moving average behind it. That's what's made it drop so long and so hard. And that's why when we break through that moving average, it's such a great opportunity, because the power that was resistance has now become support. And so right here, when we break through all those three moving averages, we can ride that train all the way and still long from 18 bucks to 32. Because that moving average, although it's going to struggle at points with the horizontals, the moving average will trump that resistance. No pun intended. Okay? So as you can see, the rules change. We're dealing with a different ball game. We don't get worried about approaching that horizontal resistance because we know momentum should win out. That changes our structure. So a couple of quick questions. What time frame do I use most? I use the hourly and the daily and the weekly. So I want all three time frames to confirm. And what I'm looking for on each time frame is a high probability pattern. Have you used these rules for spot FX? Absolutely. I teach this strategy to a group of my friends. They come over once every 2 weeks. Their fee is a nice bottle of Malbec and something for me to eat while I sit there and churn through the US versus the yen. So we'll sit there for 2 hours, and I don't trade the US versus the yen, but it's live all the time almost, so it's a great thing to use. And yes, it works on forex, it works on futures, it works on anything where smart money is involved. Does this work on intraday short time frames? Absolutely. Because what you're dealing with, what's the best way to describe it? Think about a Russian doll. Does everyone know what a Russian doll is? You know those like little wooden things? You can open it up and you say, oh, that's pretty. Let's open it up, see what's inside. Oh, that's pretty. Let's open it up and see what's inside. Oh, that's pretty. Let's open it up. You get what I'm going for. It's just the same thing again and again and again, but smaller. And that's what technical analysis is. It's basically one big jigsaw, and you say, hey, what happens if I open up this puzzle? And you just see another puzzle inside, and it repeats itself all the way down to a 1-minute chart. So that's the really cool thing. So let's use an example. So let's go and have a look at one of my favorite shorts at the moment, ATVI, Activision. So I've loved this for a long time. I've been waiting for the opportunity to short this for ages because this is the perfect trade, right? And that's what you really want to be doing as a trader. You don't want to be looking at a stock and saying, well, what should I do with it today? Well, chances are that when you look at that stock, that day, it's not going to be a perfect storm. You know, a perfect storm arises on a stock maybe 3-4 times in a year at best. So if you're restricting yourself to only trade Tesla, to only trade Amazon, because I like Amazon, I'm going to trade Amazon, fine. But you're going to be subjecting yourself to less probable trades if you force yourself to only play that trade. You see what I mean? It's kind of like Vegas. We were all, Jeanette and Andrew and all of us were down for the Traders Convention, and I sat down at the roulette table, and they hated me because I would just look for a certain pattern to come up on the wheel, and I'd throw down my $100, I'd win, I'd take my money, then I'd get off the table and search the other 8 tables around me and just run off to the next one that pattern came on. And they hate that because they know they can't get me. They get you by keeping you on one table because the system will keep changing and eventually you'll lose your money. I liken this again to trading, where people that stick with a certain basket of stocks. What I prefer to do is look for the ideal setup and wait for that setup to come. In Activision, we've been waiting for that for 2 months, and the reason we liked it was because you can see this beautiful rising wedge formation. We also could see. Let's just bring up a little cool thing I'd love to show you. All right, so we saw this beautiful rising wedge formation. So then we said, well, okay, this looks like it's going to break down. So what's the smart money doing? Bang. we saw that smart money was selling the hell out of this thing. 4.5 million shares at $40, 3.9 million shares at $40.51. This isn't small money. This is huge money, unprecedented money. It's also in a sector that had one of the highest levels of insider selling. So that obviously went in our favor as well. But above and beyond that, the chart was awesome. It told us that once we break down that rising wedge, we measure the rising wedge formation here. We then duplicate that, and that told us that there was a break from 44 to 38. And look at exactly where that dropped to, 38 bucks. And that's why we alerted the $44 May puts as well as the March $40 puts. Now, but then take that, now we zoom out and look at the larger scale. Look at the weekly formation. Does everyone see what pattern we have here? What do we have? A head and shoulders. There's a question here, how could you know it was a rising wedge until later in the chart? Because just like a good doctor, you should be able to identify the symptoms before the patient's dead. Sorry to be a bit morbid, but it is Black Friday, right? I watched too much Monty Python as a child, perhaps. But a good doctor should be able to look at his patient and say, okay, you're sneezing, you have a fever, okay, you've got a cold, right? You don't wait for it to all finish off. So when you're looking at a chart, you shouldn't have to wait for all of this to happen to see it's a head and shoulders. You should be able to look at what's controlling the stock. Straight up, straight down. We have a symmetrical triangle. That is one of the key characteristics of a head and shoulders. So check, symptom identified, a symmetrical triangle. As soon as you see that, you should be looking for a head and shoulders. Then what we see is that we break out, okay, next characteristic of a head and shoulders, and then we have a very nice symmetrical top, characteristic 2, 3, and 4. So now we should know that this is a pretty solid head and shoulders, and once we break down below it, we've now basically got that confirmed. And that's your most profitable zone to enter, not after it's already transpired where everybody else has seen it. So identifying the symptoms, which again comes back to the DNA or blueprint of the market. So Activision, in my opinion, is going all the way down to 26. I'll cover those puts then. I would wait for it to rally back to 38, 37, and I tack them on again and take it all the way down to 14 bucks. So to answer your question about time frames, you can see how the patterns and that support and resistance style all comes into place. AVGO, another example of that. This has been building in a rising wedge also since January of this year. But I'm waiting for the confirmation for this to break down below 162, and I'll ride that all the way down to 130. So again, you can see these patterns start to jump out at you when you simply follow the rules. We'll take some questions and apply this to some live stocks here shortly. But that's the key. The key to the market, the key to success is to have rules. Rules that, regardless of what you think and what's being blared out across the TV, you need to commit to a system that brings you results. And as Warren Buffett says, it doesn't matter if it's a good system or a bad system, as long as you have a system and commit to it, you'll make money. And that's what I practice every single day, as I simply, regardless of my opinion, look at a chart and say, what do the rules tell me about this particular setup? Go into the chart, identify left to right support and resistance, and say, right, what shape do those lines make, right? If you can identify support and resistance properly, you don't even need to know how to instantly spot patterns. Just simply know how to identify support and resistance, draw it on, and then say, right, what shape does that make? And then just Google it. Or if you're an Acorn student, you go and look at your visual index of all the different chart patterns and what they mean. Right? So you just simply say, well, what shape is that? Right, what does that mean I should do with it? There you go. There's the rules. No more guessing. No more going to bed wondering whether you should have pushed buy or sell. So the final checkpoint of once you've identified support and resistance is then to say, right, now how can I get extra probability by seeing where the smart money is going? And this is one of my favorite indicators, which is called Twiggs money flow. This is my favorite indicator of all from a technical basis other than support and resistance. And this, what you see on the chart here is everything I use technically to make my buy-sell decisions. Where is the support resistance? What pattern does that make? What does the rules tell me I should do? Bang. And the final checkpoint is to look below and say, what is the smart money doing? Does it agree with me? So the indicator you see below is one that analyzes all the most important qualities of a stock. Is it making higher highs and higher lows? Check. One quality of an uptrend. But a true uptrend should not only be going higher, but volume should also be increasing as the stock goes higher, right? Also, so what, higher highs, higher lows? People look at indicators for that. On balance volume, people use that indicator just to measure whether volume's going up or down with the move. Then they put stochastics on. Stochastics, all they do is tell you whether a stock's closing high or low in its range. It's all basic stuff you can see in the chart. So I just like to simplify it into one indicator. And this tells us, is the stock going up, is volume going up with it, and is it closing in the top half of the range consistently? If all of that's happening, you've got a real uptrend. If all of those things aren't happening, the smart money is simply loading the stock, propping the stock up while they sell to you, right? So money flow is key in determining true conviction of a move. And this is one of the reasons why I loved the timing of this short. Because as the stock went higher and higher, what can you see the smart money doing? We already know the insiders were selling, but what were the high-frequency trading boys doing? What were the systems doing? Selling. So for all of you Monty Python lovers, this is the machine that goes bing. Anyone who hasn't seen that skit, you should look up. The machine that goes bing. And this machine went bing, and it told us that these insiders were selling as the stock rallied, and that confirmed the entry criteria. You can look at any great short. I mean, look at Coopers and Company. This one, if this one breaks down below 165, this should be an excellent short. You can see this long-term. Let's apply our rules. If the system wants to listen to me, there we go. So there we go. We've got from left to right. We've got our uptrend. We've got our breakdown. So because we know this pattern ended there, therefore we know where to look for the new pattern. We can identify then for going left to right, horizontal resistance. You can see that we've broken down underneath that resistance, tested from beneath, breaking down again, and the real telltale sign will be once we break down below that level. Simple. What do they do? Who cares? The technicals tell us that the smart money is loading out of this stock. And if we want to then go and apply our little extra rule here, we can go and check what they're actually doing by looking at the insiders as well. And there you go. We get a similar kind of mass sell-off in the millions of dollar amount, not from just one person, but from various people. And that is just the cream on top of the cake, right? So it's not about magic. It's not a crystal ball that we have. It's just simply a rule book that we have and follow rigidly. It's not always right, but it doesn't need to be. If you have rule systems, you can get it right 40% of the time and make money. So if you get good at it and get it right 60, 70, 80% of the time, you can make lots of it. But it's about having rules, so you have to stop worrying about being right and wrong and simply have a checklist on a piece of paper or on your second monitor or up on the wall that every time you take a trade you can say, what am I doing? Have I looked at the support and resistance the way that I've been taught properly? Have I been looking at have I considered the smart money? Have I considered these different things? And of course, that's exactly what we are here to teach. I mean, I hope I could actually talk for probably another half an hour. Jeanette would shoot me, so I'll keep it to the topic. So as you can tell, this is my passion. I love teaching this, and we have no matter what you want to learn, I mean, my focus is really on systems to approach the market. If you were to ask me, what do I do the most of? It's identifying support and resistance, using that to identify if it's a high probability pattern, and if it is, look at the smart money, and if that still agrees, trade it. And what we've become exceptionally good at is now we know exactly what we're looking for by going through that process. We've then developed scans to find those things. And then that makes the whole job a hell of a lot easier. The offer today, in the spirit of Black Friday, is very inexpensive. If you want to follow along with exactly what alerts we follow, you can do so for only $9, and this gives you a month of our trading alerts. We send out videos throughout the week. They're called executive summaries, and I basically run through and scan the market using the strategies we talked about today, and tell you exactly what we're looking at to buy. We break down the pattern, we break down the smart money, we break down the options. It's basically taking, a little bite of what I've talked about today and having it every day, applying it to the live markets. We also host a show every Tuesday, Thursday with myself and two other coaches, and that's basically where we banter back and forth with a glass of Tia Maria and talk stocks. And it's all based on the core concepts of patterns and smart money. So that $9 covers you for an entire month, and it also includes the Twigs money flow indicator, which is the smart money indicator I showed you today, and that's programmed in Metastock, Think or Swim, TradeStation, TC2000, you name it. So just to cover, what the $9 includes is, so again, it's acornwealthcorp.com/win. So for the cost of a trading commission, you get me for a month. How's that sound? So yeah, so that includes the Smart Money Scan package, the Smart Money Indicator, a video tutorial on how to set it all up, unlimited support from our coaching department throughout the month, live trading room show every Tuesday, Thursday at 7 Eastern. But probably what people find the most valuable is those daily executive summary videos where we break down exactly what we're looking to trade. Now, as a bonus today, in the spirit of Black Friday, we'll also be including a video on open range. So today I've talked about the DNA of the market, so it would seem foolish to not tell you about one of the most important levels of support and resistance that applies in the entire S&P market, and that's something called open range. So I'm going to give you a bit of a teaser, just in case you're not yet sold on the $9 idea. All right, let's go to it. So, okay, this is really cool stuff. I was taught this by one of my coaches, actually. I'm humble enough to admit that I don't know it all, and in fact, I learn that every day. So this is one of the coolest things I was ever taught by one of the coaches we had a few years back, and he said, Johnny, all you need to know if you're going to start to get higher probability moves on the S&P is understand open range. Is this good for options? Yeah, absolutely. Every single stock alert we send out, Clark, has an options strategy attached as well. So you can trade the stock, you can margin the stock, you can buy or sell the options. What we're really good at doing is saying, hey, this stock's going to go from 10 to 12, and here's how you could play it. So yeah, let's get back to open range because we're probably about 4 minutes away from finish. S&P 500. So there's 2 critical days in the S&P. The very first day of the month and options expiration day. These are called open range days. And all you need to know is that when that range is set on the first trading day of the month and the third Friday, if the S&P 500 closes above or below it, that will give it, we've backtested this back to 2014, up to a 90% probability that it will continue in that direction until the next open range day. This is like the secret talk of market makers. And so what did open range tell us on the third Friday, November 18th? It had a low of 2180 and a high of 2189. We closed above that on Monday, and that tells us we're going higher until the 1st of December. Simple. And that one system tells you where to focus your scanning on, whether you're going to focus on longs or shorts, by simply knowing whether the S&P has broken above or below open range. Now there's a bit more to that, and that's why we've done a 45-minute video on how to use this properly, and that's the short version, but 45 minutes gives you the full version of that. We charge $197 for that lesson. It's included in your $9. And for those of you who obviously want to go on and learn more about scanning for patterns and things like that, you'll see some of the options of things like that when you enroll. But this basically is going to get you right into the core of what we do, the best way possible, which is say, hey, does Acorn really know their stuff? Can they help me make more money in the market? And ultimately, that's all you really want to know as a trader. And I'm very confident if you take this first step with us, it'll be the beginning of something very refreshing in your trading strategy. What's it cost after the $9? Well, you can go on for $59 a month. It depends on what you want. I mean, you can get our alerts, our daily videos and everything for $59 a month. If you want one-on-one support and live training, it's $147. So if you, it really depends on how much assistance you want. So at the end of the day, at the end of the month, if you're not making significantly more money, you know what it costs? Nothing. Just simply send us an email and say, you know what, I learned a lot for that $9, but I'll, you know, it's not worth another $59 next month. You just send us an email, we cancel you immediately. Obviously, our ambition here is to help you to make more money, and that's what keeps our customers sticking around. So yeah, as I said, best way to do is just give it a try and see if it suits your trading strategy. And go for it. Okay, so I've got some more time apparently, so I'm going to keep on talking. In fact, I just got a text message from Jeanette. It's not often that Jeanette tells me to keep talking. She's normally telling me to zip it. So let's take some questions. You know what? Since I got some time, I'll throw up a little dialogue here. This is one of the emails I got from my students, and I won't go take you through the whole thing because it's a bit lengthy. But one of the emphasis here is we're not here just to sell you results. You know, we're not trying to say, hey, just do what we do and you'll make millions of dollars. I really think it's so very important to understand the why behind the what. And I think this email really kind of hit the nail on the head. You see, my feedback for your course is all positive. I find your method of processing and teaching and training excellent. You have skills and abilities in this area beyond most so-called educators in the finance space. I don't say this lightly as it comes from someone. I've had senior roles in the education space, a regional director of adult education and training, so I know a little about the process. Key things that he mentions though, in soaking up your dialogue and teaching method, I've learned to not micromanage trades, trade with lower degree of fear and stress, actually sleep at night with orders in the market and live trades on, validate what I have read, know and understand about the statistical side of trading, winning and loss ratios, from years of trading, doing courses and learning by inculcating your dialogue. He's obviously a better educator than me, I don't understand that word. Putting your teaching into my trading persona, the biggest gain from Acorn I've ever had in my education process, but simply transmuting knowledge into behavior. And that's the thing. I mean, it's one thing to know how to trade. It's another thing to actually be able to do it. And that's why we focus a lot on the why behind the what. Let's have a look. I think I've got another message here from Jeanette. Let me just check. Okay. All right. So, so folks, look, we're going to have to wrap up. Our next speaker, Larry, is here. I will leave my lots and lots of testimonials here. One sec. Let me just leave my information up. If you have any questions that I haven't been able to address for you, you can simply drop us an email or give us a call. And I'll leave my information up here on the screen. There we go. There you go, info@acornwealthcorp.com or phone 1877-272-2676. Thank you, everybody. Guys, it's been a wonderful session. I'm so glad you enjoyed it. It's always an absolute pleasure to be here with TradeThirsty and all these wonderful speakers. Andy was great to listen to, and of course you have another wonderful speaker coming up next. So I'll pass it over to Larry, and have a wonderful rest of your Black Friday and weekend. Take care.
All right, everybody. Johnny, put your link back up. Okay, there it is. Okay, acornwealthcorp.com/win. That's for his $9 trial. I'm pretty sure I've never seen Johnny do that before, where he just offered it up like that for people who want to take a test run of all the stuff that he does for his clients and the students that he teaches. And so, you know, I don't know that you'll ever see it again. So there
Never.
it is.
Never.
You can't say it like you ever.
We can teach you that too, Jeanette.
All right. See you soon, man.
See you, mate. Cheers.
Okay.